What's good, Reed here? Look, I don't normally cover this kind of thing, but the on-chain footprint on this one is so loud I genuinely can't ignore it. Let's walk through it. The forensic snapshot we're analyzing today was pulled on June 13th, 2026. Bitcoin is trading at $64,145. That follows a 21.38% slide over the last 30 days, leading us nearly 50% below the all-time high set back in October. This chart maps price action against the Fear and Greed Index. Today hit 13, extreme fear. Despite this drop, look at the volume bars below. Network activity holds at peak interest levels, even as price hits local lows. If retail traders are in a state of extreme fear and dumping their holdings, we have to ask, who is providing the buy-side liquidity required to absorb these millions of dollars in sell orders? This gap between public terror and network volume is what we call the sentiment liquidity divergence. In this environment, surface-level volatility creates a screen of noise. Sharp price drops trigger retail panic, which generates the dense sell-side liquidity large-scale buyers need to fill positions without spiking the price. Public market psychology has detached from the activity recorded on the ledger, creating a blind spot for anyone trading based on their social media feed. To find where that capital is moving, we have to look at the broader market. Ethereum is currently holding at $1,677, largely stagnant. This visualization shows the ETH to BTC ratio dropping to 0.02615. Liquidity drains from altcoins, flowing directly into Bitcoin. Even traditional safe havens like Pax Gold are trading flat at $4,215. Usually, a systemic exit from crypto sees money move to gold or fiat, but gold is sideways while Bitcoin's internal on-chain volume is surging. Capital is staying within the digital asset ecosystem, concentrating heavily into Bitcoin. Today's whale wallet tracking shows a clear pattern. Large blocks of capital move onto exchanges, execute buy orders, and transfer off-platform into cold storage. These transfers occur in uniform batches and specific intervals, the signature of algorithmic execution. This is a disciplined, programmed accumulation. Institutional participants are treating these extreme fear levels as a liquidity window to build long-term positions. Most of this volume bypasses public order books. Institutional desks operate over-the-counter, or OTC. Back-channel data from these desks shows a supply squeeze. Brokers are currently finding it difficult to source enough Bitcoin to satisfy the demand from their large clients. These private transactions don't immediately push the spot price up, which allows the accumulation to continue quietly while the public price remains suppressed. For a retail trader, this creates a psychological trap. You see the red candles and the macro gloom, and the natural impulse is to exit before things get worse. I've made this mistake before, letting narrative noise talk me out of a position right when the on-chain data was signaling a floor. While retail reacts to the news cycle, the participants with the most capital are using that emotional selling to build their inventory. Indicators like the Fear and Greed Index measure the sentiment of participants who are currently being shaken out of the market. Trading on public sentiment alone often results in providing the exact liquidity whales need to finalize their entries. We can verify this by tracking the life cycle of coins on the network. We use UTXO age bands. This chart visualizes Bitcoin supply by time last moved using UTXO age bands. Old coins, held for years, remain stationary beneath a flat line chart showing zero selling pressure. Only the glowing young coins are active. Veterans from previous cycles are simply not selling. The volume we're seeing today is almost entirely comprised of retail coins being panic sold at a loss. Whales are catching these coins using algorithmic limit orders the moment they hit the exchange. Once they are purchased, these retail coins are moved straight into deep storage, effectively removing them from the tradable supply. The data centers on the $64,145 level. This has become an algorithmically defended zone of accumulation. These age bands show that while short-term holders are exiting in a panic, long-term capital is absorbing that supply. Zooming out, we see a clash in timeframes. Retail is focused on the 30-day drawdown, while institutions are positioning for the next 30 months. Moving this much supply into cold storage creates a structural supply shock. When retail demand eventually returns, there will be significantly fewer coins available on exchanges to meet that buy pressure. By the time the Fear and Greed Index returns to the greed zone, the large-scale buyers will already be fully positioned. The blockchain ledger provides a map of reality that is often the direct opposite of the emotional noise on social media. We are watching a systematic transfer of wealth as impatient retail assets move into the hands of patient institutions. And that's the breakdown. 3 quick favors. Like the video, subscribe to the channel, and most importantly, share this with anyone who's holding a bag in that ecosystem. They deserve to know. See you next time.